Welcome to Electrified. It's your host, Dylan Loomis. Hopefully, I'll be back on camera sometime next week. So, I'm sure you've all seen Tesla cutting prices in China and a few other markets by now, but just want to touch on a few things. First, at some point, don't forget, if production falls too far and the utilization rate of the factory is too low, lowering prices to increase demand to bring the factory utilization rates closer to full capacity is actually a really good thing. And nothing has changed with Tesla's goals. They still want to increase volumes, they want to continue to drive down manufacturing costs, and through this process, they're hoping to keep gross margins somewhat steady. And yeah, they'll fluctuate a few points here and there, of course. But I just wanted to show you this chart so you can see the price comparisons for Tesla in China throughout time at the beginning of each year. And you can also see the percent changes if you compare to the beginning of 2021, 22, and of course, the beginning of this year. These two boxes are colored in with green because that was the after subsidy price. So that is, of course, gone. And these are the current prices right here. The biggest price discount from a US dollar perspective was around $6,500. Now, that wasn't the case across the model lineup. That was just for the rear-wheel drive Model 3. The long-range Model Y also saw a similar price reduction. And now, if you look at the differences in the cost between the United States and China, you can see that across the board, it's between a 31 to a 46% difference for the same vehicle, just in different markets. And remember, these subsidies right here are no longer available. So compared to the beginning of 2021, Teslas are only down in the neighborhood of between 3 and 13% depending on the model. But the price wars are officially on in China and Tesla is not holding back. This move will put pressure on BYD as this brings Tesla much more in line with BYD. The Model 3 is now the equivalent of around $1,000 more than the BYD Seal, and the Model 3 is the same price as BYD's best-selling Han EV. And I don't know why more people aren't talking about this, but Grace Tao said on Weibo that the price cuts in China reflected engineering innovation and answered Beijing's call to encourage economic development and consumption. And more from Grace Tao from Ray for Tesla. Behind Tesla's price adjustments, there are countless engineering innovations, which are essentially unique and excellent cost control mechanisms, including but not limited to vehicle integration design, production line design, and supply chain management, and even optimize the robot arm coordination route at the millisecond level, starting from the first principle and insisting on cost pricing. Wouldn't it be awesome if Tesla broke out its margin by region? And Matthias gave us another good reminder. Don't forget what Elon said on the Q2 call. We've raised our prices quite a few times. They were frankly at embarrassing levels. I'm hopeful this is not a promise or anything, but I'm hopeful that at some point we can reduce the prices a little bit. Reuters added, so far, there's been no sign of Tesla cutting prices in Europe. And honestly, guys, this should not come as a surprise to anyone who's been listening. Have a listen to what Elon said just a few weeks ago on a Twitter space.
The reality is, if we are in a recession, I think we are in a recession, and I think 2023 is going to be quite a serious recession, and it's going to be, in my opinion, comparable to 2009. I don't know if it's going to be a little worse or a little better, but I think it's in my view, likely to be comparable. That means demand for any kind of optional discretionary item, especially if it's a big ticket item, will be lower. And then with the Fed increasing rates, which is really, this is quite unusual. This is like when you're heading to a recession, you should be reducing the Fed rate, not increasing it. So that amplifies the difficulty. So now you have sort of structural demand, which is obviously going to be lower in a recession, and you amplified the effective cost of a car because they're almost all bought with debt. So you get a double whammy, is what I'm saying. So then the obvious choice in that scenario is: do you want to grow unit volume, in which case you'll have to adjust prices downward, or do you want to grow at a lower rate or go steady? It's sort of a choice there. My inclination would be to still grow. My bias would be to say, like, okay, let's grow as fast as we can without putting the company at risk, which would mean in that scenario, profits would be low to negative during a recession, provided the cash position is okay. I think that's still the right move long term, and the so because there's also something that Tesla possesses that other car companies do not, which is extremely fundamental. That is that the cars are upgradable to autonomy, and so and arguably an autonomous car is worth many times what a non-autonomous car is. So even if your margins are extremely low in selling the car, the subsequent upgrade to it being autonomous is worth a lot. So, and that's something that no other car company can do. Is only Tesla can do that. I mean, I stand by my prediction that long term, that Tesla will be the most valuable company in the world. I'm actually fairly confident that will be what happens. I would say Tesla's probably, in my best guess, most valuable company in the world in less than 5 years.
And I just think it's funny that no one's really talking about the other automakers that are in the midst of this price war that's starting in China and will undoubtedly branch out to Europe and the United States as well in time. But again, Tesla has the margin to give. They can actually lower prices and still be somewhat profitable. And Elon said that they will continue to lower prices so they can continue to grow unit volumes throughout this recession. But what about pretty much all the other companies that are making EVs unprofitably that are also now in this price war? How are they going to fare? Why is nobody worried about them? Anyway, touching on this tweet that got a lot of traction. So it was a video of some people kind of storming a Tesla store in China, but I just want to be clear. I can't really confirm when this happened or exactly what's going on. Of course, people were trying to make this out to be people rushing to buy Teslas, but we know that Teslas are purchased online. Although, sure, maybe some of these people wanted to go shop and actually look at a Tesla in person before they buy one, but we have to remember something else as well. Reuters told us that some Tesla owners in China who took delivery recently are planning protests at showrooms in China due to these price cuts that they, of course, missed. So this video was shared on Twitter today, but again, I can't confirm when this footage was actually taken and or what these people are actually doing. Is it protests? Is it people looking to buy a Tesla? I don't really know. It could be a little bit of both, so just be careful with this one. And personally, I would just apply that same level of skepticism to all posts that are talking about things like the website being down and showroom exploding with customers. We don't know when these pictures were from, and this is of course nothing against Emmett, but I'm just saying in general, tread cautiously. More importantly though, I did want to show you this from Pierre. This is great analysis. So between the fourth quarter this year and the fourth quarter next year, he's saying Tesla can lower the average sale price by around 8% without making a dent on margins. This grows the addressable market by 50%. In a recession, demand tanks around 10 to 15%, so Tesla will still be able to grow units around 36% out of an addressable market growing at 50%. Now, if that didn't make any sense the first time around, it's actually pretty simple. So as you can see, this chart basically breaks down auto demand at different price levels. So as Tesla lowers the pricing, as you can see, bringing average sale price down into the 40,000 range, that's going to give Tesla access to a wider range of demand, as when you lower the prices, it's going to open up the market of people that can afford your vehicles. So what Pierre is saying that even if Tesla lowers prices by 8% throughout 2023, that'll give Tesla access to a 50% larger addressable market. So Pierre's saying today, Tesla's average sale price is around $50,000, meaning their addressable market is around 20%. But as the average sale price drops to around $46,000, their addressable market would go to over 30%, aka a 50% increase. And importantly, they say right here, we model Tesla growing 14 points slower than its addressable market. This is a recession scenario. So as Tesla drives average sale prices down, which again, we want it to do, we want more people to be able to afford a Tesla. This has been their goal all along. As that happens, the auto revenues in gray and the deliveries in this orange color will both go up. And Pierre added, Tesla can lower materially selling prices without hurting margins for multiple reasons. The ramp of Berlin and Austin will improve the average unit costs, subsidies in the United States, the end of shipping from China to Europe, which will of course take time, and improving supply and input costs, which is exactly what Grace Tao was talking about Tesla has been doing in China. So yeah, Tesla is one of, if not the only automakers that can sell EVs for less, continue to make a profit because of relentless manufacturing improvements, and simultaneously grow unit volumes as they work down the price curve and gain access to a broader market of buyers in a recession. And listen, keep this data in mind as you listen to what Brett Winton from ARC has just said about Tesla. And shout out to Alex Voigt for the clip.
In 2017, and it basically took the industry 4 years before there was a range and cost competitive vehicle with the Model 3. With that 2017 Model 3, and their cars haven't stayed the same. In March, we think that Tesla's going to announce a new vehicle platform, and that the cost of manufacture for that vehicle platform will be roughly half the cost of the Model 3. If you look at what happened when they released the Model 3, they had a massive gross margin expansion and massive unit volume expansion over multiple years. I think the same thing is going to happen with the new vehicle platform they announced in March. And so they're going to set the standard for the industry again. The industry will again be 4 or 5 years behind. And for shareholders, it's a great outcome. You end up with a company establishing a strategic footprint in a massive, literally $1 trillion plus market, and likely to dominate and soak up all of the profits out of that industry as the rest of the competitors.
Even in China.
So do not let it be lost on you what that Generation 3 platform, whenever Tesla decides to bring it around, what it's going to do for Tesla's addressable market. Moving on just real quick, there is now a Model S and X retrofit for a regular round steering wheel. Still no stocks, and it will have the capacitive buttons, but nice to have this option available. $700 should be available in March this year. In case you missed Tesla Daily yesterday, the Model S and X both now have the option for a regular wheel or a yoke. Both are included with the cost of the vehicle. And one update for the Model S and X Plaid, it looks like they're both getting higher thermal capability brake calipers. And yes, it's just 1 month of data, but I wanted to share it because it's the first month that the Model Y has been on sale in this market. Tesla began delivering the Model Y to Taiwanese consumers on December 5th, and within that first month, Tesla registered almost as many Model Ys as the next 5 best-selling cars combined. Here's the data for the top 5 in December. We also got this from Coverager. Tesla has filed for a new insurance program in Texas. Now, they've already been offering their insurance through Red Point County Mutual since October 2021, but now Tesla is intending to write new business beginning March 1st, 2023, and offer new policies to policyholders being non-renewed by Red Point effective again March 1st, 2023. So this could be Tesla insurance in Texas going from the third-party underwriting to Tesla bringing that underwriting in-house. But that's just my speculation from this quick blurb from Coverager. And last up for today, Edward Jones, where I used to work as a financial advisor for 4 years, has now upgraded Tesla to a buy from a hold rating previously. I can just tell you right now, Tesla's CFAs that work in the home office and put together these stock ratings, they're a very conservative company. So what that means is if they have a buy rating on a stock, you can be fairly confident that it's a pretty good buy. And as you can see, also, we are adding Tesla to the Edward Jones stock focus list, which is basically a list of their favorite stocks to buy. And I've scrolled down a bit so you can pause and read if you like. I'll just highlight one sentence. Tesla shares are currently trading at about 20 times our 2023 earnings estimate. While this is a significant premium to other automakers, it is below valuations of other high growth companies. We believe shares are attractive given our growth outlook. But that'll do it for today. Hope you guys have a wonderful and a safe weekend. Again, thanks for your patience as I try to work back up to full speed, continuing to recover from COVID. Please like the video if you did, and a huge thank you to all of my Patreon supporters.